Hey, what's up, everybody? Welcome back to Investing Sucks. So, anyone who's ever explored the world of YouTube finance before has probably been bombarded with videos telling them the best stocks to buy right now or the best stocks to buy for 2023, right? And I think that deciding when to buy a stock is a pretty easy decision to make. Once you've kind of done a bit of research and you've convinced yourself that one particular company is going to go up in value in the future, deciding to buy a stock is a pretty easy decision to make. But deciding when to sell a particular stock is much more difficult, in my opinion. It's not really something you ever hear people talk about when they're discussing their personal investing because it is such a difficult decision to make and it doesn't really carry the same flair that talking about the stocks you're buying has. So, what I want to do today is quite possibly the most innovative thing to ever hit the YouTube financial scene, which is make a video talking about when to sell a particular company. So what I want to do in this video is take you through my personal process that I personally use when I'm deciding if it's time to sell a particular company, and then also talk about some other methods that people may use when making that decision. At the end of this video, I want to show you a new feature that I just added to my website here, tickernomics.com, which is a website I created to help retail investors analyze public companies. And this feature is designed to help you pretty much decide when to sell a company. So I'll show you that later in the video. For now, let me take you through my personal process. So after I've made an initial investment, what I like to do is I'll keep track of when the company's quarterly earnings calls are. I'm sure you guys all know what those are, and you've probably tuned into one before if you've been investing on your own for a few years. But the whole point of these earnings calls are to get management's commentary on the company's results, and then also have analysts ask probing questions to management to help investors understand the business better. Now, I know value investors out there, we love to harp on analysts and we love to say, don't listen to analysts. They know nothing, don't take their opinions seriously. But the reality is, analysts do actually serve a very important role to the investing public by asking these probing questions to management and putting management on the spot and critically assessing, their responses, what their plans are for the future, how they're managing the business, things like that. So the way you can get this information is you basically just get the earnings call transcript if you don't have the time to tune into the actual earnings call itself. You can usually just find this on the investor relations page for whatever public company you're investing in. And for example, here I'm on JP Morgan Chase. I'm not personally invested in this company. I'm just using it as an example. So if I go to the earnings call transcript, you can just click it here and then there's a PDF and you can read through this. It's only 18 pages. It really doesn't take more than 15, 20 minutes to go through it. And ideally what you're trying to do is find clues that could change your thesis as to why you invested in this company, right? So really the first step of deciding when to sell a company is to actually have a solid thesis on why you invested in them in the first place, right? A well thought out list of reasons. I think this company is going to deliver stellar returns because of X, Y, and Z. And because those are your reasons, and you need those reasons to become true in order for that investment to actually work out, then you want to monitor the company after you've invested in to make sure those things are going as planned, right? Because a lot of times, management could give some projection, and maybe your analysis had something to do with looking at management's projection and valuing the company based on that. And then you concluded it's undervalued based on what management thinks. So the reason it's undervalued is because investors disagree, but maybe you agree with management, whatever the case may be, right? So if management then lowers their guidance, then you're like, okay, that's material information that I need to actually understand the implications of. And I can go back, revisit how I valued the company in the first place and made the decision to buy them. So with a company like JP Morgan Chase, this is a very large company. I mean, one of the biggest banks in the world. Some clues that you might be looking for, just to give you a bit of flavor on this, is say they're saying they expect their net interest margin to go down in the coming quarters or the coming years. They expect their fees to go down, the fees they charge for the various services, because they're a big company. They have a lot of different operations. Maybe they're expecting, the economy to worsen, so they're projecting higher credit losses in the future because they are a bank. So credit losses are a big part of how they make money. They want to keep those low so they don't, lose a lot of the loans that they've lent out, things like that, right? And obviously, a company like this is going to give guidance on that. And there's plenty of examples you could look at for whatever company you're investing in. So really the first step is you have to actually genuinely understand the company you're investing in and what needs to happen for that company to actually do well in the future and get, the above average returns, which ideally is why you invested them in the first place, right? If you're just projecting, average returns for a company, then there's really no reason to invest in the company to begin with. And I know I talk about this all the time, but I really want to drive this point home. You know, there's no point taking on the additional risk of investing in a company if you only expect them to give you, say, 5, 6% returns, right? Because over the long term, 25, 30 years, you can likely get those returns just by investing in index funds, low cost index funds. So there's no point going through the whole research process, putting your capital at risk, your hard-earned money at risk, investing in just one company if you're not at least expecting to get, well above that 15, 20% annual returns for however long your holding period is. So let's say you read the company's earnings call transcript, and then you start to believe that your initial thesis in the company has changed a little bit. Whether it's for better or for worse, you feel like it has changed. So this is where I want to introduce the new feature that I just added to my website, Tickernomics here. I know it sounds like I'm plugging my website again. The website's currently free, by the way, tickernomics.com. I'll leave a link in the description. Anyone's new to my channel and you want to check it out. But the whole reason why I created this website is to help retail investors, is to help people make better investing decisions, right? And it's a tool that I personally use, and I kind of designed it based on what I thought would be helpful. And I think by doing that, other people will probably find it helpful too. So the way you do this is the feature here, you go to portfolio, and then it gives you kind of some stats about your portfolio, but you want to go to this new option here called portfolio analysis. So here is a few companies that I own that I've talked about on this channel before. I'll zoom in a bit just in case no one can read that. I don't own Microsoft, by the way. I kind of just had them in there as an example. But let's take this one, Malibu Boats. So this is what the feature looks like. And what it tells you is your cost base, so what you initially bought the shares for, the current price, what your return has been thus far, any dividends you've received, your total annualized return based on how long you've held them for, and also changes in shares outstanding depending on how long you've held the company for, because that could influence your ownership if the company's buying back shares and you own more of the business. But what's really helpful is this chart here. So this actually maps the company's stock price starting from when you initially bought them to whatever your calculated intrinsic value is, which you can enter in this table here. So you can just double click and, enter it and edit it here. Or if you want to use the actual DCF calculator that we also have on this website, you can just click this button and then you can kind of run through this, enter all your assumptions. It calculates the DCF analysis for you. You just enter your assumptions here and then it will update accordingly. And I think being able to visualize how your intrinsic value, based on your analysis that you did, compares with the stock price, because you often hear like value investors discuss this type of thing, right? Like the price and the value of the company are different things. They're constantly changing, they're constantly fluctuating. This allows you to actually observe that relationship in real time, and you can update your analysis as you go and change the date. So, for example, say I read the earnings call from last quarter, and now I think instead of worth $81 a share, I think they're worth 75 USD a share. So I can enter that, and then I can go back a few months. So let's say I go to November 2nd, and then it's going to update, and basically, you can see the intrinsic value is now lowered based on that. So I'll update the date here. Yeah, and now you can see the chart has you can see the intrinsic value has decreased right around that date that I put it there. So you can map the relationship as you go through this process where you're constantly updating your assumptions about the company, you're learning new information about them, and you're changing what you think the company is actually worth, and then comparing that to what the actual stock price is. Now, last thing I want to cover on this feature, the way to actually get these companies to show up here is you have to start by entering transactions. So you enter your transactions on, basically the information on the date when you bought the company, what the company is, what price you bought it at. And then once you've done that, they will show up in this feature here, the actual companies. And as you add transactions, all this information here will update. And don't worry about us like spying on what transactions you've done. Like that data is going to be encrypted, so we can't actually observe it. So the next step in my personal process in deciding when it's time to sell a company is two things can either happen. One, the stock price raises to a point where it's now within, say, 90, 95, 100% of what my calculated intrinsic value is for that company based on my assumptions and my personal opinion. Once it gets close to that, then I feel it's time to sell, because at that point it's no longer undervalued, right? So it's a good time to sell, and then maybe in the future, if the stock price drops again and you feel the inherent value in the business hasn't changed, you could buy in again. But the fact that you're doing this analysis and you have some kind of logic and reasoning behind why you think the company is worth what it is, and then comparing that to the stock price. To me, it seems like the most logical thing to do. The other thing that can happen is some new information comes out about the business that you didn't foresee, or maybe no one foresaw it, and the intrinsic value is now a lot lower than what you initially thought. And again, it's kind of within that range of 100 to 90% of the stock price. Then again, you might want to look into selling. That's my personal process. That's the process I use. And I think having all this information available here can help a lot with that. And then what you also notice is down here, I've included a section where it kind of looks at basic valuation metrics and it shows you how those have changed from what they currently are versus what they were when you initially bought the stock, right? So there's the price to earnings ratio here, the price to book ratio. And we can see for this company in particular, the PE ratio has expanded since I've bought it. It was 6.6 when I bought it. Now it's 7.4. Similar with the price to book ratio, similar with the price to sales ratio. The EV/EBITDA ratio has decreased and so forth, as well as some other information like what their operating margin was as of their most recent quarterly filing and what the debt to equity ratio was. So this information I think can help people a lot. And it covers a really, I would say, a negative side of this whole process, which is that the process I'm describing here really only works for companies that you can actually value using the discounted cash flow method, which obviously is really the best way to value a business because it determines what the business is actually inherently worth. But not all businesses you can reasonably do that, right? The DCF really only works for a handful of companies. There's lots of companies like tech companies that are currently operating at a loss, banks, insurance companies. The DCF method just doesn't really work for those. And usually the approach that people take when you can't use the DCF method is the multiples approach, right? So you look at valuation multiples, look at how those have trended over time. So this is why this feature exists. For example, another company I own that I've talked about before is Equitable Bank, and this is a bank, so I would actually be looking more at the price to book ratio personally. And we can see, at purchase it was about 1, and it's depressed a little bit since I've bought it. So these are the types of insights that can help you a lot, and yeah, that's why I created this. Now, this system that I just described, it sounds really good in theory, right? Following a structured approach like that, it sounds good in theory, but actually implementing in practice is pretty difficult to do. And the reason it's difficult is because of something called the endowment effect. So I think as an investor, it's really important to be aware of the common cognitive biases that essentially just plague our ability to make smart investing decisions, because there's a lot of studies out there done in the field of behavioral finance which show that when it comes to making decisions about money or decisions about investing, humans just generally suck at it. But at the same time, you can't just simply be aware of these effects because you can't trick your mind using your mind, right? There's a reason these common biases and all these, things that get studied, there's a reason they exist, right? And it's because we all fall victim to them. So what the endowment effect is it's basically people's tendencies to place a higher value on things that they own as opposed to if they did not own that thing. And it doesn't just apply to investing and owning companies, it applies to many different things. But basically, what the risk of this is it's tough to be objective in assessing a stock that you own if you own it, right? Because you may fall victim to this endowment effect. And I think this is particularly hard when you're dealing with a stock that's lost a lot of value because then, you're dealing with the emotions of being down severely in a position. It's really, really hard to be objective and actually analyze the company and, follow this process that I described here. So, what can we do to mitigate this? Well, personally, what I would say I think is a good idea for investors to do is when you're starting out, kind of developing your thesis in the company. So, before you actually own the company, so you don't have to worry about this, is you should develop a range of scenarios, right? Don't just value the company based on one scenario that you think is the most likely. Develop a range and kind of ascribe different likelihoods to each range. So, again, I'm going to use the example of Malibu Boats, which I know I talk about this company. I've brought up this example many times, but I think it's a good example. So I'm going to use the value of stock feature, which is right here. And this, like I said before, it's a DCF tool. So you enter the company, all these boxes here just get populated based on 5-year historical data, but you can obviously update it. And then it actually calculates the value here. So let's kind of do a pessimistic scenario, right? And again, you'd want to do this analysis before you own the company. So let's say worst case scenario, the revenue growth is only 2%, right? Personally, I think it'll be higher than that, but let's say their revenue growth we'll do a 7-year analysis as well, is just going to be 2%. So basically what we would expect inflation to be. Their operating margin, it's been expanding over the years because we can see the 5-year average here is 15%. And then we can also see the what it currently is just about 17.5%. So let's say it's 15, right? Tax rate will leave that the same. Capital expenditures, depreciation will leave that the same. Working capital will leave that. And let's just leave everything else the same to be simple. And we'll use a terminal value multiple of 10. And then our discount rate is about 10.5%, which it calculates using this information here. It automatically calculates it for whatever company you entered here in step one. So we'll calculate the DCF, and then we can see based on those pessimistic assumptions, the company's pretty much at fair value right now, right? Or it's actually slightly below it. So the current price based on those assumptions is higher than the intrinsic value here. So it's good to do that analysis before you buy them, because then you have that scenario you can always look back to and say, okay, if this investment doesn't work out like I thought it would, I can refer back to this. And now you actually have something you can follow as opposed to trying to make decisions on the fly. Now, another scenario where it may make sense to decide to sell a stock is if you're looking at your portfolio as a whole and you've done the work in valuing the company, so you've got the intrinsic value calculated, and this is just an example that I'm showing here, hypothetical. So say you own 4 stocks, these are the intrinsic values, and then these are the current stock prices that they're at. This here is the current price as a percentage of your intrinsic value. So you think all these companies are undervalued. And again, this is going to be constantly changing depending on updates to current price and what you think the business is worth. Then we've got the discount rate used. And then this last column here is your expected return on an annualized basis. So what you're projecting to earn. Now, let's say you come up with a new idea, right? There's a new stock you found and you go through your analysis and you think that the expected return is 17%. Now, this is higher than what the expected returns are on some of your other companies. So what you may decide to do is sell, for example, stock 3 here, which has only a 12.6% expected return, and replace it with the one that you think has a higher expected return, because then that increases your portfolio return overall. As we can see with these 4 stocks here, your portfolio return is 16.5%. If you were to replace stock 3 with this new stock here, it goes up by 1.1% to 17.5%. So this, again, this is pretty theoretical, but you can actually implement this in practice. And it does assume that you have, again, done the work and you've actually have a reasonable estimate of what you think the business is worth. So you can kind of understand that when it comes to deciding when to sell, the best way to have a structured approach to it is to do the work to begin with, right? And have an intrinsic value, something you think the business is worth, because then you can constantly refer back to that and then also update it along the way. So anyways, guys, that pretty much does it for this video. I hope you did find this useful and you did find it insightful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate if you'd consider subscribing. And I'll see you guys in the next video.